Let's move on to the big topic, which is dominating the news right now and dominating stock market moves for sure. US GDP came in at a big disappointment for the first quarter. What do you think happens to monetary policy as a result of that? But it seems to me that nobody is, surprised or shocked or adjusting their forecasts based on this surprise GDP number, and I think they should be.
Well, Nick, there's sort of a flawed assumption in your question, and again, I understand it's a question, not your opinion, but you're assuming that the Fed knows anything about the economy, but they don't. They have models that are probably worse than the climate models I just talked about that don't really sync up with how the real economy works. So I can tell you exactly what the Fed's going to do. It's not because I have inside information or a crystal ball. That's not the point. I can tell you because the Fed tells you. All you have to do is listen to them. The Fed is so determined not to surprise the markets, not to throw any curveballs, that they signal everything in advance. And if they do change policy, and every now and then they do, they'll signal that, 4 or 5 months in advance. So if you're still in the trade when they change the policy, then shame on you because they gave you plenty of warning. So there's sort of no drama, no surprises. That doesn't mean they're getting it right. It just means that they're telling you what they're going to do. So they raised 25 basis points in March. They raised 50 basis points in May, just the other day. They announced QT. That's quantitative tightening. It's the opposite of quantitative easing. I still run into people, they yell and scream and they bang the table. The Fed has to stop printing money. I'm like, hey, they did 5 months ago. They don't, QE is printing money. But they're doing the opposite. They're doing QT, quantitative tightening. They're reducing the base money supply, and they do that through one of two means. They sell securities to dealers. The dealers pay them, and the money just disappears. When the money comes inside the Fed for the Fed's own account, it disappears. Or you just hold a security to maturity, at which point the Treasury pays you off. You don't have to sell anything. You sit and wait, collect, and that money disappears. So the Fed announced that they're doing that to, it'll vary, but approximately $80 billion a month. But $80 billion times 12 is $960 billion. So call it $1 trillion for a round number. So they're going to reduce the money supply by $1 trillion a year. Now, coming back to the rate hikes, they did signal they're going to raise 50 basis points in June. Okay, so March, they don't meet every month, but it's every 8 weeks. So crazy kind of schedule, but so 25, 50, and 50. So there's 1.25% increase by the end of June. Then they have another meeting in July, September, I think November and December are the last 4 meetings. And they may go back to 25 basis points after the June meeting, but that would still leave you at 2.25% minimum, but it could well be 2.5 or higher by the time we're done by the end of this year, and kind of a projection to keep going on into 2023. Now, getting back to QT, quantitative tightening, this is an inexact science, but the best estimates are that every $500 billion reduction in the balance sheet, which is what we're talking about, is roughly equivalent to a 1 percentage point increase in interest rates. So here we're looking at $1 billion. I'm sorry, a trillion, 500 billion equals 1%. So we're looking at $1 trillion before the end of the year. So that would be about 2%. So there's sort of 2% implied or effective rate hikes through QT on top of the 2.25% that we expect. So that's going to have the equivalent effect of a 4.25 or higher percentage increase in interest rates, percentage point increase in interest rates by the end of the year. That we haven't seen that since the Volcker days of the early 1980s. So, so then the question is, what is that going to do? Well, it's going to do 2 things. It's going to put the U.S. economy into a recession, and it's going to trash the stock market. So the Fed doesn't see that. They'll be the last to know, but it'll happen. Then they'll read about it or something, and then they'll kind of wake up. But here's the point. When it becomes apparent that the Fed is raising into weakness, which you described, GDP was down 1.4% annualized in the first quarter. Second quarter, it's early days, but Some projections are about 2%, but we'll see how they hold up. But you're looking at, even if that does hold up, first quarter, second quarter combined, roughly flat for the world's largest economy. One rounding error away from recession, possibly worse. So the economy is weakening. The Fed is tightening into weakness. That's a recipe for a recession. So what you have to say is, but why is the Fed tightening at all? The answer is inflation, which is coming from, that comes in two flavors. There's what's called demand pull and cost push. So demand pull is when you and I and all of our neighbors decide inflation's out of control and we better go buy stuff fast before the price goes up. So if you're thinking about a new car, or in my case,
buying a freezer full of food, yeah,
a freezer full of food or whatever it might be, you better hurry up and get it out. And by the way, I lived through this in the 1970s. That's exactly the way it was. If you actually thought about getting something, you said, why wait? The price is going up. I better go get it right now. So that's demand pull. That's not what's driving inflation right now. We may get there. We may get there, but we're not there yet. We're seeing what's called cost push inflation, which comes on the supply side. Higher, we talked about this, higher energy prices, higher food prices, because of the supply chain disruption, because of the war in Ukraine, et cetera. Well, the Fed doesn't plant wheat. The Fed doesn't drill for oil, and the Fed's not in the container cargo business. There's nothing the Fed can do to control the cost push inflation. So except cause a recession. That'll do it, but nothing short of that will do it, because the Fed can't actually fix the supply chain or increase the supply of goods or drill for oil or do anything else that you might need to do. So, but the danger, there are a number of dangers, but one is at what point does cost push inflation create demand pull? Where I'm so used to seeing, price of gas at the pump has doubled and food has doubled or tripled, depending on the category, et cetera. Everything's going up, where where my psychology starts to change a little bit. We're not there yet, but we could get there. And then it really does run out of control, because then you have to do something extreme to change the psychology back again. So the Fed doesn't really understand anything I just described. You and I do, and our listeners do.
But Jim, they understand politics, though.
Yeah. Well,
so
it's a good reminder that Jay Powell has not been confirmed as chairman. He's acting in an acting capacity, which is legal. He's the acting chairman, but he was renominated by the Biden administration. The Senate has not confirmed it. Could you pull that nomination? Yeah. Could the Senate shoot it down? Yes. I don't think it's likely, but it's certainly possible. But it gives Jay Powell his marching orders. I mean, it's sort of like hanging a sword at Damocles over his head. Like, hey, Jay, you better get rid of this inflation before the election. But what no one seems to grasp, at least no one in Washington, and that's its own thought bubble, that the cost of getting rid of inflation is to cause a recession. I don't see any scenario. I see scenarios where they tighten to an extent, realize that they're going to cause a recession, and back off. And that's exactly
my expectation. Yeah.
Yeah. And that may, well, first of all, with good reason, Nick, because that is what happened in 2018, 2019. They went through a tightening phase from 2013 to 2018. First, it was taper talk, then the actual taper, then they finished the taper, then they raised rates in 2015, took a whole year, raised them again in 2016. It wasn't until 2017 that the clockwork, lockstep, 25 basis point thing started. And then, but in October 2018, the stock market began to crash, and culminating in the Christmas Eve massacre, December 24, 2018, when the stock market fell 3% in one day. But the Fed had been tightening as late as mid-December 2018. And that's my point. A stock market observer would have said in September at the latest, certainly by October, November, hey, you cut it out, you're going to sink the stock market. The Fed kept tightening. Finally, it got close to disorderly, close to a more extreme crash, and the Fed backed off. And first said, we're not going to raise anymore. Then they said, well, we're going to cut. And they said, oh, we're going to do some QE6 or whatever it was. And then here comes the pandemic. And guess by 2020, we were back to zero. And the balance sheet had gone from 3.5 trillion to 7 trillion. So in other words, in 2020, they were back to where they started in 2013, except worse, because the balance sheet was even bigger. So that was a 7-year round trip and a failure because they never did normalize. They got close, but they could never pull it off. It's not going to take 7 years this time. It might be more like 7 months. And the reason is twofold. Number one, we're more leveraged and the stock market is more bubbly. And so the whole thing's more vulnerable. Number two, the market has seen this movie before. Like, hey, we watched this play out. We know it doesn't work. And the Fed blocks. Now, so if the Fed suddenly slams on the brakes, says we're not going to keep raising rates along the lines I projected earlier, okay, that might give the stock market a boost. And you can't assume that won't happen. You got to watch for that. But I would expect that things would have to get pretty ugly in all events before the Fed got that message. On the other hand, if Powell gets confirmed and feels like it's his last term and here's his chance to be Paul Volcker and he's just going to keep raising rates, he said, my job is to get inflation under control. The rest of you people, you're responsible for fiscal policy and tax policy and spending and shutting down the Keystone Pipeline,
welfare,
and all that. That's on you, not me. My job is to get rid of inflation. If he does that, and he might, you're looking at a recession, that kind of looks like the global financial crisis, and hope it doesn't. And there is a difference between extreme recession and financial crisis. They're two different things, but they can happen at the same time as did happen in 2008.
So I just want to clarify then. On the one hand, there's this political fear of inflation. And on the other hand, there's the fear of a recession. And a sort of subpart of that is financial instability, is a financial crisis. And when I said to you, the Fed knows about politics, you focus on the inflation threat. Whereas the thing that I was implying is that they don't want to cause a recession, and they especially don't want to tighten into a recession, because that's like a deliberate act of sabotage, isn't it? And then sort of connected to that is the idea that I believe that the higher mandate in all of this is financial stability, because financial instability causes a deflationary shock, which is even worse than high levels of inflation. So I think their cautious move would be to say we're more worried about a recession and a financial crisis style event than we are about inflation. So we are going to backpedal. We are going to keep things a lot more loose, and that's what I was trying to get to with the politics. So surely they're more focused on avoiding 2008 than allowing the 70s.
Well, broadly, I agree. I would do just a couple tweaks on that. Number one, would the Fed back off if it became apparent that they were going to cause a stock market crash, a disorderly collapse, and a severe recession? The answer is almost certainly yes. But the problem is it might happen anyway. In other words, they might have gone too far. And this almost happened in 2018. And that was my point. It was by the time they realize their mistake, it might already be too late. So that's one danger, which if they had perfect information, oh, gee, we went too far, gee, we couldn't pull this off, we need to back off. They might back off exactly as you described, but they don't have perfect information. They have flawed models. They tend not to look at history, and they could
behind the curve.
They could crash the car before they knew it was out of control. Number one.
It's almost tradition for the Fed to do that over the last 40 years. Right?
1929. There are some examples. 1936, so they have a track record of that. So that's one problem. They, in theory, they would back off, but they might. It's like slamming on the brakes on ice. You can slam on the brakes, but you're going to go for a long time before the car stops. So that's one problem. The second problem is you have to separate, as I said, recession, even severe recessions, from financial crises. In 1998, we had a financial crisis, but no recession. In 1994, we had a financial crisis, no recession. In 2020, we had a severe recession, no financial crisis. That was not a financial crisis. In 2001, we had the NASDAQ collapsed 80%, but there was only a very mild recession, and that was not a financial crisis. And we don't have time to get into all the reasons for that. There are reasons for it, having to do with leverage and interconnectedness. But so the Fed might say, and again, might, because who knows, but they might say, well, of course we don't want a financial crisis. Now, to your point, Nick, nobody wants that, and they do get out of control. But we're not worried about that. You know, we learned our lesson in 2008. We had Dodd-Frank. And I had this discussion with James Gorman, the CEO of Morgan Stanley. I briefed their board, and they gave me a lot of pushback. They said, "Oh, you don't understand, Jim. We have more capital and greater liquidity and less leverage and better credit." And I granted, I said, "You're absolutely right. I said, nice job. You're a stronger bank now than you were then." But in a financial crisis, it doesn't matter. The problem is systemic. In other words, as an individual bank, you may be better off, but if the whole system's collapsing, you can't necessarily withstand that. So they don't want that. But what if they said to themselves, you know what, we don't want a financial crisis, but we don't think that's going to happen. But maybe we'll just have to bear a recession. Volcker knew what he was doing. Volcker knew that there was going to be a recession. And the recession of 1981-82 that he caused was at the time the worst since the Great Depression. Now, we've surpassed that twice since then, 2008 and 2020, although it's hard to know what 2020 was. I mean, down 36% in 2 months and up 38% in the next 2 months. I mean, what is that? But at least in technical terms, we've had two worse recessions, 2008 and 2020 since then. But at the time, and I lived through that, I was around, that was the worst recession. But Volcker knew that would happen. He said, that's the price we have to pay to break the back of inflation. And he did. And by 1986, inflation was like 2% or 1.8%. Now, there was far less worry about financial crises at the time. Because remember, this was before the repeal of Glass-Steagall. You know, commercial banks, no one really cared about investment banks. They could fail. So what? They cared about the commercial banks, and they had a pretty good handle on that. So they weren't worried about financial crisis. But today you would be for the reasons we mentioned. So
he also had a democratic mandate to do that, which you've pointed out in strategic intelligence from two different presidents.
Well, that's right. And so so there are two possible major blunders here, but again, don't underestimate the Fed's ability to do both. One is that they could decide they don't want a recession, but not know until it was too late. They just tighten into it, don't know it until it's too late, and then the damage is done. The other one is they could sign up for a recession, say, yeah, sorry, but that's the price of getting inflation under control, and trigger a financial crisis that nobody wants but could happen anyway. So, you know, it's kind of so and Charybdis, you know, take your pick.
Or they can let inflation run and reverse their policy now. I think I sum it up at the end.
That's option three, Nick. So just think about what we just said. Severe recession, but we know it's coming. Recession that causes a financial crisis that we didn't want, or just let the inflation rip. What's the good outcome there? What's the good one?
Yeah.
But I think those are the three choices. I think you're right.
Yeah. It's a three-way tightrope walk. At the end of the weekend daily reckoning, I say if the Fed and the Bank of England and the RBA really do tighten monetary policy to the extent that they're saying they will in a recession, and which may not even come close to the inflation rate, then I think that it won't just be effigies of Jerome Powell. They'll be burning on Wall Street. I think things will get drastic in politics, especially after the Reserve Bank of Australia promised not to raise rates until 2024. So it's just sabotage. It's just I'm sure some populist politician somewhere will come out and just vilify central bankers, and I'm sure he'd get a lot of support.
Well, in 1982, during the depths of that recession we just talked about, a lot of people lost, but one of the big losers were farmers because you know, prices were coming down, and you know, inflation raised their costs, but the prices were going down. And they had it wasn't a trucker conflict, but a lot of people drove tractors to Washington, and they had a Constitution Avenue, and one guy drove his tractor up the steps of the Federal Reserve. But you're right. Maybe next time they'll just keep going and break the door down.